Stop what you are doing right now, because silver is sitting at one of the most dangerous technical crossroads I've seen in months. Here are 4 silver products that will not go up in price. Silver demand is surging, industrial usage is hitting record highs, investors are rushing in faster than they have in years, and yet a massive number of people buying silver right now will barely make anything. Some will even lose money. Not because silver won't go OPA, but because what they're holding doesn't actually move with silver. And that raises a dangerous question. Are you investing in silver, or are you holding something that only pretends to be silver? Because right now there are 4 specific silver products that millions of investors own that look legitimate, that feel safe, but quite are even recommended many places. But the most important rule in investing, they don't track the asset they represent. So what are these products? Why don't they rise when silver rises? Who keeps buying them anyway? And most importantly, why do experienced investors avoid them completely? We're going to break all of that down. But first, you need to understand something that almost nobody explains clearly. Silver is not one single market. It's a system with layers. When silver enters a bull market, demand doesn't just increase in one place. It comes from everywhere: solar panel production, electric vehicles, electronics manufacturing, retail, investors, institutional capital, all at the same time. And that creates pressure. But here's the twist. That pressure doesn't hit every silver product equally. Some forms of silver absorb that demand directly. Others only feel a fraction of it. And some are almost completely disconnected, which means 2 people both believing they're invested in silver can experience completely different outcomes. One sees strong gains, the other sees almost nothing, and the difference comes down to one thing: exposure. And the first type of exposure that fails, it's one of the most common mistakes people make, are Piragu CT number 1, silverstacking items, silver-plated products. You've seen them everywhere, maybe you've even owned them. Jewelry that shines like silver, cutlery labeled as premium silver, decorative items that look expensive. At first glance, they feel like a smart buy. They look identical to real silver, but they're not. Silver plating is exactly what it sounds like. A thin outer layer of silver applied over a base metal. That base metal could be copper, nickel, brass, and the silver coating. Sometimes thinner than a human hair bar. So when silver prices rise, what actually happens to that item's almost nothing, because the total amount of silver in that product is incredibly small. Even if silver doubles, the actual increase in intrinsic value is minimal, sometimes just a few cents. And that's the best case scenario. Because here's where things get worse. Markets don't price these items based on silver content. They price them based on utility or scrap. That means something you believed was an investment is actually just a consumer product. It doesn't scale with the market. It doesn't benefit from demand. It just exists. And selling it, that's where reality hits hard. When you try to sell silver-plated items, don't calculate silver value. They don't care about spot price. They don't care about market trends. They see base metal. And that realization is brutal. Because time passed, silver moved, but your asset didn't. Now, if that seems like an obvious trap, one is far more deceptive, because it actually does contain silver. But RCT number 2, numismatic. This is where even serious investors get confused. As numismatic coins, rare coins, graded coins, collector editions. These are often marketed as premium investments. And technically, they are made of silver. But no. So they should rise with silver, right? Not necessarily. When you buy a collectible coin, you're not primarily buying silver. You're buying rarity, historical significance, condition grading, collector demand. And those factors operate in a completely different market. That means something unusual happens during bull markets. As silver demand explodes, don't most investors to collectibles. They rush into liquidity. Bars bullion coins, easily tradable forms, not niche collector pieces. And here's the irony: sometimes collectible coins underperform because silver is rising. Investors' capital rotates. Investors sell high premium collectibles to buy more ounces of riding pure silver exposure. So instead of riding the wave, these coins can stall or lag behind or even decline relative to spot. That's one of the most frustrating positions to be in. You were right about silver, but your investment didn't reflect it. And if that feels like a mismatch, the next one is even more subtly. Product number 3, SilVR ETFs and PRSilVR. This is where modern investing gets tricky. Silver ETFs are everywhere. They're easy to buy. They're highly liquid. They're often the first choice for new investors. And on the surface, they seem perfect. You click a button and you own silver. But do you really? When you buy an ETF, you're not holding physical metal. You're holding a financial instrument designed to track silver. And under normal conditions, that works reasonably well. But bull markets are not normal cracks appears. That's where, in a true bull market, doesn't demand just push price higher, create scarcity, real-world scarcity. Dealers run low on inventory, premiums increase, delivery times extend, physical silver becomes harder to obtain, and that's where things diverge. Because ETFs don't capture that. They track spot price, not scarcity, not retail demand pressure, not supply constraints. So while physical buyers are paying higher premiums, ETF holders only see the base price move. They miss the full picture. That means you can be positioned in silver, watching about short to see and not fully part surgery, heed about rising premiums, seeing headlines and budget minds about chain premiums anticipating. Gap is you can assist in fickle and fully participantly. Themes you can be pissed price move and miss the full pificantly. Why isn't my silver keeping up? But this leads to a much bigger realization. Silver isn't just about price. It's about how that price is formed, and that changes everything. Because there's one final category that people expect to outperform everything that should benefit them rising silver prices, but often ends up disappointing investors the most. And once you understand why, you'll never look at silver investing the same way again. Most investors think they understand silver. Buy low, wheat, sell high. Simple. But here's the uncomfortable truth. Even if you perfectly predict a silver bull market, you can still underperform. You can still miss gains. And in some cases, you can still lose money, not because you were wrong, but because you chose the wrong vehicle. And this next one proves it. PRDCTL VR midi esto que es view in underperformers, silver mining stocks. On paper, they should be the best way to play a silver bull market, because when silver prices rise, mining companies generate more revenue per ounce. Higher prices, higher profits, higher stock prices. That's the theory. But reality looks very different. When you buy a mining stock, you're not buying silver. You're buying a company, a business with moving parts. And those moving parts introduce risk. Let's break that down, because this is where most investors underestimate the problem. A mining company doesn't just dig silver and sell it. It has to explore for deposits, secure permits, build infrastructure, hire labor, manage logistics, deal with governments, handle environmental regulations. And each one of those steps adds complexity, and complexity creates friction. So even if silver prices rise sharply, that doesn't guarantee profits rise at the same pace, because costs rise too. Energy prices increase, labor becomes more expensive, equipment costs rise, supply chains tighten, and suddenly the margin you expect starts shrinking, and that's just operational risk. There's also geopolitical risk. Many silver mines are located in regions with unstable regulations. Governments can increase taxes, change royalty structures, restrict exports, even nationalize assets, and when that happens, shareholders pay the price. Literally, because not all companies are run well. Wow. Bad decisions, poor capital allocation during bull markets, and all of these can destroy shareholder value. So market values, people, all that silver rising, even watching bull markets. All of these can especially underperform silver because not all comfort for resin. Even small stocks, so trading experience would stack up. If that's one the most fredices in investing, you got the big picture right, you saw silver rising, you positioned early, and still your returns lag behind. And this is where everything starts to connect to. This isn't really about silver anymore. It's about how exposure works. Because markets don't reward ideas. They reward precision. And if your exposure is inefficient, your returns will be too. So now the real question becomes, what actually moves in a silver bull market? What captures the full upside? But before we answer that, there's one final mistake almost everyone makes. They assume all physical silver behaves the same. But it doesn't. Even within physical silver, there are layers. Bars V's coins, government, minted V's, private, high premium V's, low premium, high liquidity V's, low liquidity. And each one responds differently in a bull market. And those differences become extreme. One demand surges because markets prioritize liquidity. In a fast-moving bull market, buyers want assets they can trust pretty quickly. That creates a reckoning and trade hierarchy. Some forms of silver become highly desirable. Others get left behind. So two investors, both holding physical silver, can still experience completely different outcomes. And this is where the real advantage appears. Because now we shift from mistakes to strategy. Because smart investors don't just buy silver. They think in systems. They ask deeper questions. How liquid is this? How tight is the spread? Will demand increase for this specific form? Can I exit quickly if needed? Because those factors drive real returns. And this is where most people fall behind. If you're only watching spot price, you're missing structure. If you're only following headlines, you're missing mechanics. And mechanics determine outcomes. They're just direction. Nuction is easy. Execution is where money is made or lost. And here's the part if to understand. A bull market doesn't let people still don't know things equally. It amplifies differences between efficient exposure, inefficient exposure, but liquid assets. The liquid assets between real demand, perceived demand. Most people think investing is about being right. Right about timing. Right about the asset. But real investors know that's only half the game. The other half is choosing the right vehicle. Because in markets like silver, not all exposure is equal. Some positions grow, some stagnate, and some quietly fall behind while everything else moves forward. So the next time silver starts to run, don't just ask, is silver going up? Ask something better. Am I holding the kind of silver that actually moves when it does? Do you think most investors will rotate into better silver exposure in time or stay stuck in underperforming products during the next bull run? Drop your take in the comments. I read every single one. And if you want to understand markets at this level, not just headliners, but the mechanics behind them, make sure you subscribe. Because most people follow markets, smart investors understand them before they move.